Welcome, curious minds, to another deep dive. Today, we're tackling a real American icon, a company that's been part of the landscape for generations, Ford. It's a really fascinating case study, actually, because, well, on paper, it might look like your classic value stock, but there are some, let's say, genuinely complex challenges humming under the hood. Okay, let's unpack this. We've pulled together some pretty compelling data that paints a really nuanced picture of where this automotive giant stands right now. Our mission for this deep dive, we want to explore Ford's current financial health, get a feel for the market sentiment, and then maybe the most interesting part, dive into those technical chart patterns, the ones that often show what investors are actually doing. So whether you're just curious about the shifts in the economy or you're keenly watching the future of big manufacturing, I think you're going to find some surprising facts and insights here. Let's start with the immediate stuff, the financial snapshot. Ford stock is currently trading around $10.48. It's seen a significant tumble this year, nearly 12% down year to date. And wow, over 35% down from its 52-week high.
That's quite a drop. But despite that fall, it still grabs a lot of investor attention.
Yeah, it does. And what's truly fascinating here is how the numbers initially present Ford. It's almost like, well, a bit of a mirage sometimes. You've got a market cap around $42.8 billion. That's the total value, right? And it certainly looks like a classic value stock. When we look at its forward price to earnings ratio, comparing share price to expected earnings next year, it sits at a low 8.15. Now, for context, the broader market often trades way higher, so that number alone kind of suggests it might be undervalued. Then you've got a price to sales ratio of just 0.23, which means its whole value is less than a quarter of its annual revenue. That can look attractive. And then there's its EBITDA, near 17.
Okay, hold on there. For those of us maybe not staring at these numbers daily, what exactly does an EBITDA of 17 tell us? Why is that significant here?
That's a great question because, yeah, it adds another layer. So EBITDA is enterprise value to earnings before interest, taxes, depreciation, and amortization. Bit of a mouthful. Basically, it compares the total company value, including debt, to its core operational earnings before those non-cash expenses kick in. Now, a high number can sometimes suggest inefficiency, but for a giant like Ford, around 17, well, it could mean the market expects operational improvements, or it could signal some concern about the quality of those earnings. So yeah, while other metrics look cheap, this one adds maybe a little note of caution about efficiency.
Right, so it sounds like a real mixed bag. Some attractive numbers, some less attractive right out of the gate. But as we dig into the recent performance, yeah, the picture definitely gets more complex. We're talking Q1 2025 earnings. Now, Ford did manage to beat analyst expectations for EPS earnings per share, reporting 0.14 cents, so slight beat there. But the overall revenue was down a noticeable 5% year over year to $40.66 billion. And the really stark number, net income, their profit after everything, it plummeted a staggering 64% to just $472 million. That's a huge drop for a company this size.
It is, and this raises a really important question. How can a company look so attractive on those valuation metrics, yet show such concerning, almost alarming earnings? The key, I think, is in the significant headwinds it's facing. Like that $1.5 billion tariff impact they reported, that isn't just a number on a page, it's a massive strategic blow. It was so severe it forced management to pull their entire full year financial guidance, and that's rare. This stark admission of just how unpredictable things are, a really difficult operating environment.
And the challenges don't stop there, right? Their electric vehicle division, the one they've hyped up so much, despite billions poured into it, it's still stubbornly unprofitable. You'd think with all that investment they'd be seeing returns, but nope, not yet.
Exactly. The EV division's unprofitability is a major drag, especially when they're trying to pivot to the future. It costs a fortune. And adding another layer here, let's look at the balance sheet. It shows over $100 billion in long-term debt. Now you couple that with a debt-to-equity ratio of 3.5. That means for every dollar of shareholder equity, Ford has $3.50 in debt. That's very high leverage.
So what does that kind of debt level actually mean for a company like Ford, especially in today's economy? It sounds like it could be a really heavy burden.
Precisely. That high leverage isn't just a number. It's a significant strategic constraint. It really limits their flexibility. Investing aggressively in new tech, expanding into new markets, that all gets harder without taking on even more risk, and makes them much more vulnerable in a tightening interest rate environment like we're seeing now. Borrowing costs go up. Suddenly that huge debt pile gets more expensive just to service, and that eats into potential profits. Now, some might argue Ford's assets and cash flow can cover it, but the market clearly has reservations. You can see it. And if we connect this to the bigger picture, analyst sentiment is also quite cautious. Only 15% of analysts currently rate Ford as a buy. That's way below the S&P 500 average. Plus, S&P Global Ratings recently downgraded Ford's credit outlook to negative. They specifically cited profitability and, well, capital structure concerns.
Yeah.
The debt, basically.
That makes perfect sense. So they're facing internal operational issues, external pressures, and a cautious view from the financial gatekeepers. What about that PEG ratio you mentioned? It was 6.25. What does that tell us in this context?
Right, the PEG ratio. Price earnings to growth. It's another important indicator. It basically tries to measure if a stock's price is justified by its expected earnings growth. A PEG over 1 generally suggests the stock isn't growing earnings fast enough to justify its current valuation. Ford's 6.25 is, well, quite high. It indicates that while the stock might look cheap on a PE basis, its anticipated earnings growth just isn't robust enough. It suggests a lack of strong growth momentum, really reinforcing that challenging picture.
Okay, so we've painted a pretty tough fundamental picture here. Ford looks like a value play on paper, but then you see these struggles with profitability, the heavy debt, cautious analysts, slow growth. But is there any way the market isn't seeing this? What do the technicals into the cold, hard reality of how people are actually trading the stock, what do they reveal? Let's turn to the charts. They often show that collective sentiment maybe hint at future possibilities.
Absolutely, and the charts tell an interesting story. From a long-term perspective, if you look all the way back to April 1999, Ford's stock was stuck in this prolonged downtrend. What that means is it kept forming lower highs and lower lows, a classic sign of bearish momentum. Sellers just kept pushing the price down. This major bearish move finally hit a historic low near $1.15 back in November 2008. It basically wiped out all the previous lows. An extreme low like that can often indicate, a potential long-term bottom, a kind of reset moment for the stocks chart where maybe the worst of the selling is over.
Okay, here's where it gets really interesting. What happens next in the charts? It sounds like there's a twist. After hitting that low, Ford started a bullish recovery. You said it was structurally confirmed in November 2021. What does that mean to break a key market structure?
Good question. Breaking a key market structure means the price pushed past a really significant historical resistance level, a point where sellers had previously always won and then stayed above it. This signals a pretty fundamental shift in the long-term direction. It suggests buyers have taken control and that old downtrend is definitively broken. It's a very bullish signal for long-term folks. Currently, as you said, the stock's trading around $10.48, and it's moving within what technical analysts call a descending channel. Think of it like a downward sloping corridor the price has been bouncing around in. It respects both the upper and lower trend lines, kind of outlining its recent trading range.
That's a powerful visual. So within this channel, where are the key spots? Where have buyers historically stepped up, and where do the sellers tend to show up?
Yeah, we can identify some strong demand zones where buyers have historically stepped in with real force. There's a major monthly demand zone between roughly $3 and $7. This zone got powerfully confirmed during the March 2020 COVID crash. The price dipped right into that area and buyers just rushed in, driving it up significantly. Showed immense interest at those levels. More recently, looking at the weekly time frame, there's a more minor demand zone around $8.70. Buyers showed interest there previously, so it's a more immediate area of potential support.
And on the flip side, where do the sellers tend to emerge? Where does that selling pressure usually kick in?
Right now, the price is sitting near a minor supply zone, right around $11. That suggests some immediate resistance. Supply zones are basically areas where there's a concentration of sellers ready to unload shares, often leads to a pause or even a reversal. Above that $11 level, there's a fresh supply zone between, say, $12.90 and $14.80. And that aligns almost perfectly with the channel's upper trend line. So these zones indicate areas where selling pressure might ramp up as the price climbs, making it tough for the stock to break out easily. They hint at potential pullback points.
Okay, so for people watching the charts, analyzing the movements, given these key technical levels, what are the most likely immediate scenarios? How might this play out?
Well, based on these levels, there are probably two main short-term scenarios on the daily chart. First, if the price gets clearly rejected from that $11 zone, hits it, and turns back down decisively, that signals strong selling pressure. In that case, we might see the price head lower, potentially targeting that $4 to $6 range, which lines up with those stronger long-term demand zones we talked about. The second scenario is if the price actually manages to break and close decisively above $11. Then the next hurdle is that higher supply zone between roughly $12 and $14. Now, if it gets rejected from there, it could still see a pullback towards that same $4 to $6 range. Suggests significant potential downside if those supply zones hold firm.
What about a long-term buying opportunity? For someone thinking longer term, not just short-term trades, when would that potentially materialize based on this technical view?
Yeah, for a real long-term buying opportunity, we'd probably be looking for the price to test that big monthly demand zone again, down between $3 and $7. The key isn't just hitting the zone, but seeing a clear rejection from that level or strong evidence of what we call accumulation. Accumulation is when you see signs that large institutional investors are quietly buying up shares, often signaling they believe in the long-term value at those lower prices. If that happens, if we see that buying conviction down there, well, that could set the stage for a powerful long-term target, maybe $18.50, potentially even beyond that, aligning with a more sustained bull trend.
So pulling this all together, given everything we've uncovered, what should you take away from Ford's current position? We've seen this company that, yeah, on paper, looks like a compelling value investment, strong brand, established cash flow. But then we layered on the recent earnings struggles, the really significant debt, that stubbornly unprofitable EV division, and the cautious analyst sentiment. It all suggests Ford is navigating an incredibly tough, complex transition period. It's like a legacy company grappling with a truly massive, almost existential shift.
It really brings us to the core question, doesn't it? Is Ford on the cusp of a powerful comeback story, where it successfully reinvents itself, maybe even dominates in EVs? Or will it remain under sustained pressure as it grapples with these huge, often conflicting challenges? Its ability to actually execute on that ambitious EV strategy, manage costs effectively, especially now, and deftly navigate global trade risks like those tariffs, that will be absolutely crucial. It determines the future trajectory, whether it can finally break out of this tough spot. This isn't just about numbers. It's about strategic agility, the ability to adapt, really.
Yeah, this deep dive truly highlights that delicate balance so many established companies face right now. Leveraging their history, their traditional strengths, while trying to adapt super quickly to a radically changing future. It's a powerful reminder that even the most familiar names, these titans of industry, can be navigating incredibly complex waters, facing profound existential shifts. It kind of reminds me of Ford's challenges back in the 70s, needing to completely rethink things. This isn't their first rodeo with big shifts, but the speed and scale today, it feels different. So what does this all mean for you? As you think about companies like Ford, maybe consider this. How do these long-standing brands built on decades of tradition and existing infrastructure, how do they truly balance those strengths with the immense pressures and also the opportunities of new technologies and global economic shifts? It's a profound challenge, one many are grappling with right now, and it will undoubtedly shape our future economy. Could create some unexpected winners and losers in the process. That's it for this deep dive. We hope you feel a little more informed and maybe a lot more curious about the fascinating world of business and investment.